Hi friends, welcome to my YouTube channel. Today we are going to discuss about the journal. So journal is the first accounting cycles in which the transactions are recorded systematically from the source documents. Though the source documents is the basis for recording of transaction, the source document provide the evidence for recording of transaction, but journal is the first accounting book in which the transactions are recorded systematically. This is the reason for which journal is to be called as the prime books of entry or original books of entry. So since the transactions are first recorded in this book, that is the reason for which it is known as prime books of entry or original books of entry, because it is the books of origin from which the other accounting books are started. Like journal is the basis for ledger, journal is the basis for recording of transaction, and it provides the books in which all transactions are recorded chronological order. So let's come to the journal. Journal constitutes the two words. This is jod and na. Jod means there is the chronological order. This is called jod, and null means that is the event or transaction. So journal means the chronological recording of events or the transaction. That means journal is the recording of transaction in a chronological order in the accounting books. So that is the journal. So for recording of transaction, you need to understand the basic accounting rules of debit and credit for the accuracy of recording of transaction. So let's come to the journal. So when we are going to start the recording of transaction, first there is a certain sequence or the steps to be followed for recording of transactions. This is called steps of journal. There are certain basic steps to be followed for recording of transactions. That is, the first step is analyze the transaction. Then second step is identify the two accounts involved. Identify the two accounts involved. Then third step is classify accounts. Then fourth is apply the rules of debit and credit. Then fifth step is make journal entry. So these are the steps of journal. First, analyze the transaction. Second, identify the accounts. Identify the two accounts involved. Analyze means that whether the transaction is business transaction or not. Then second, identify the two accounts involved. Identify the type of accounts involved. That is, identify the type of accounts involved. Then third, classify the accounts. Fourth, apply the rules of debit and credit. Then make journal entry or journalizing. So that is the steps to be followed for recording of transactions. Example: Ram started business with cash rupees 50,000. So this is the transaction. First, analyze the transaction. Yes, this is a business transaction or accounting transaction because it is measured in terms of money. Then identify the type of accounts involved. That means the accounts is first cash account, second there is capital account. Because Ram is the owner who started the business with cash. Ram invested money in the business, so it is the capital. He given the cash, so that is the cash account, capital account. This is the step 2. Then third, classify the accounts. Cash is a real account. Capital is the personal account. Then apply the rules of fourth step. Apply the rules of debit and credit. Real account, debit word comes in, credit was goes out. If it is traditional approach, cash account. Under modern approach, cash is a asset account, capital is the capital account. So under the asset, modern approach asset account increases in the asset debit, decreases in the asset credit. Capital increases in the capital credit, decreases in the capital debit. So apply the rules of debit and credit. So real account, cash is a real account, so debit word comes in, credit word goes out. So cash here comes to the business, cash is debited, cash account debit. Capital is the personal account, debit the receiver, credit the giver. So Ram here gives the money to the business to start the business. So Ram is the giver, that means capital account is the creditor. So capital account, that is credit. Then fifth step, make journal entry or journalizing. Journalizing means the process of recording the transaction is called journalizing. How will record the transactions? So this is the format of journal. So this is the format of journal. First column date column, second particulars column, third ledger folio column, fourth debit amount column, fifth credit amount column. The date column, that is the column in which transactions are recorded chronological order, means according to the date here. First you have to write here year 2020. Suppose the month is October, so date is first, transactions. Begins from the first October 1st till it continues till the last October 31st in chronological basis. So this is the 2020 October 1st transaction. The transaction is Ram started business with cash 50,000. So in particulars column, you have to record the entries. Particulars is the column in which journal entry is to be recorded. Means the process of recording the transaction is called journalizing. You will do here journalizing. What journalizing you will do? That is the, we had done here cash account is debit, capital account is credit. So write the transaction. That is cash account debited to capital account. So this is the journal entries. Then you have to give a brief narration to the journal entry. That is being business started with cash 50,000. So there is the narration. That is the brief narration to the journal entry is to be needed, because to understand the transaction meaning, journal entry meaning, this is the journal entry, this is the narration, this is the date column, this is the particular column, then ledger folio column. Ledger folio column stands for the reference page number of the ledger book in which cash account, capital account is recorded or maintained. So cash account, suppose the page number 1 and capital account page number 2. This is the reference. Practically it is used, but theoretically it is not used. Then cash account in the debit amount column, this is 50,000. Credit amount column also 50,000. So that is the format of journal. This is how journal entry is to be recorded. This is the debit amount column, amount debited, credit amount column, amount credited. So this is the recording of journal. So likewise, all the transactions are recorded. All the journal entries are to be recorded likewise by following the steps of the journal. Recording of transaction is to be done. So next comes to the types of journal entries. So this is the way of which the transactions are to be recorded in the journal format. Okay. So let's comes to the type of journal entry is to be recorded. So this is a one journal entries. Sometimes in transaction 2 or more than 2 accounts is involved. Then how it will be recorded. So there is this type of journal entry is called compound journal entry. So this is a simple journal entries. Now I am showing there is the types of journal entries. Okay. Simple journal entry, then compound journal entries. Simple journal entry, there is the journal entry in which 2 accounts is involved. That is 1 debit and 1 credit. This is simple journal entries. So this cash account debited to capital account is a simple journal entries. So example, that is cash account debited to capital account. So this is the simple journal entries, because one account is debit to another one account is credit. So this type of journal entry is called simple journal entries. When the transaction involved more than 2 accounts, then it is called compound journal entries. That means more than 2 accounts is involved. So this type of entry is called compound journal entries. Example, that paid to Hari rupees 18,800 in full settlement of rupees 19,000. So this is a compound journal entry because more than 2 accounts is involved. First, we have paid to Hari, one account, Hari account. Then second, there is cash account. We have paid the Hari's cash account. Third, there is discount account. So 3 accounts is involved here. Where we will go for the recording of transaction. Suppose October 2. This is October 1. This is October 2nd. So we had paid to Hari. So Hari, when Hari we had paid to Hari, Hari is the receiver. So Hari account debited. Hari account debited to cash account to discount receipt account. So this is 19,000, 18,800. Then yes, discount is 200. So that means 2 account is credited, 1 account is debited. This is called compound journal entries. Narration being 18,800 paid to Hari in full settlement of rupees 19,000. So this is compound journal entries. This is simple journal entry. This is compound journal entries to be done. This is the types of journal entries. Process of recording transaction in the journal book is called journalizing. There are 2 types of journal entries there. There is a simple journal entry in which 1 account debit, 1 account is credit. Compound journal entry you had seen when 2 account is debited or 2 account may be credited. So this is the 2 account, 1 account debit, 2 account credit. So in other transaction, when we receive the cash from Hari, 18,800 in full settlement of 19,000, there cash account debit, discount allowed account debit to Hari account 19,000. So that means 2 account is debit, 1 account credit, or 1 account debit, 2 account credit, or 2 account credit to 2 account debit, or 2 or more than 2 accounts are debited, 1 account is credited. So this type of journal entry is called compound journal entries. Next comes to the type of different. Next comes to the types of different journal entries. let's come to the types of journal entries. These are the different types of journal entries are there. So first is your opening journal entries, second is your closing journal entries, third is your adjusting entries, fourth is your transfer entry, fifth is your rectification entry, sixth is your shares entries. First is your opening entries. Opening entries means the journal entry which is to be passed in the first day of the books of account at the beginning of the year. The journal entry which is passed to open the various books of accounts is called opening entries. That means the different accounts balance are to be transferred from the past year to the current year through a journal entry is called opening journal entries. That means here the journal entry, this journal entry is to be done like this, that all assets account debited to all liabilities account to capital account. That is balance sheet figure. That means assets minus liabilities equal to capital. So this entry is called opening entries. That means all assets are debited, all liabilities are credited. The difference amount, that is assets minus liabilities, the difference amount is to be credited to capital account. This is called opening entries. This entry is to be done at the first day or at the beginning of the date of the accounts. The first opening of the accounts, that this journal entry is to be done at the beginning of the year to open the various books of account is called opening entries. Then comes to closing entries. This closing entry is to be done at the end of the year to close the various books of accounts. That means trading account, profit and loss account. This two account is to be debited and credited by transferring all the accounts for closing the books of accounts to find out the results and balance sheet. So this is called closing entries. Then adjusting entries. Adjusting entries are the entry which is to be adjusted for the expenses, incomes, depreciation, interest on capital, etc. That means the 12 months transaction is to be recorded in the books of accounts. If there are some transactions are 11 months, some transactions are 13 months, then there we need adjusting entries. Means wages suppose paid for 11 months, 1 month is outstanding. This is adjusting entries. 1 month wages is to be adjusted. Likewise, salary paid for rent paid for 13 months, 1 month paid in advance. So that is the prepaid rent, that is also adjusted. Depreciation, it is not a expenses, cash expenditure, so it is to be adjusted in the books of accounts. Interest on capital provided, interest on drawings charged, outstanding income, advance income received. So this bad debt recovered, these are the various types of adjusting entries. Then transfer entry. This entry is to be done by transfer from one account to the other account for the balancing or adjusting. That means X account is to be debited with 200 and Y account is to be credited with 200. So this is a transfer entries. Then rectification entries. That entry is a journal entry which is to be wrong, done mistake. So this entry is to be rectified by doing journal entries, that is called rectification of entries. That means errors, mistakes are to be rectified by passing a journal entry is called rectification entries. And the last is your share entries. Shares entries means for the issue of shares, recording of transaction, we make a separate entry that is called shares transaction or the shares entry. So these are the various types of classification of journal entries. while we are going for the recording of transactions, this type of journal entry should be understood. For the recording of transactions, so this is the recording of transactions. Any errors are rectified. This is for shares recording in the books of transactions. This is called share entries. So these are the various types of journal entries to be done in the recording of the books of accounts, and the journal is to be classified into two books. So this is called types of journal entries. Today we discuss about the journal, the steps for preparing the journal, then types of journal entries, simple entries, compound entries, then again broad classification of journal entry into the different categories. There is opening entry, closing entry, adjusting entry, transfer entry, rectification entry, and shares entries. So this is about the beginning of the journals. Thank you.